They held out until the absolute final moment. They waited until the final pages were being turned, until the books were nearing their closure. Then, on the very last trading day of the year, they executed their plan. If you're glancing at your monitor right now, you're witnessing a vast expanse of red. Silver is currently trading at $70.50. We've plummeted from a peak of $75, effectively surrendering all gains made over the preceding 48 hours. For countless investors, this feels like a profound breach of trust. You endured the market's turbulence. You placed your faith in an anticipated surge. And now, mere hours before the dawn of a new year, your investment portfolio is hemorrhaging value. But I'm here to assure you that what you're observing is not a fundamental shift in the market's trajectory. It's not an indication that silver's potential has evaporated. Rather, this is a liquidity event, a desperate scramble for cash. This entire situation is being orchestrated by a specific regulatory mandate that compels the world's largest financial institutions to liquidate assets and hoard dollars by December 31st. In this emergency market breakdown, we will meticulously examine the New Year's Eve price collapse. We will elucidate the reasons behind the simultaneous descent of gold and silver. We will scrutinize the Basel III regulations that necessitate this sell-off, and we will explain how this downturn is in fact setting the stage perfectly for the January effect, which commences in less than 48 hours. The banks are meticulously tidying their ledgers, making one final effort to shake the tree. Don't let them claim your harvest. This is the narrative of the final purge. To comprehend the reasons behind silver's precipitous decline today, one must first understand the mindset of a banker on December 31st. For them, today isn't a day for trading, it's a day for accounting. At the stroke of midnight, regulators will meticulously document the financial standing of every major bank's balance sheet. This snapshot will determine their capital requirements for the subsequent year, as well as their systemic risk classification, their GSIB score. If a bank holds an excessive amount of highly volatile assets, such as silver, gold, or equities, their score escalates. An increased score translates into billions of dollars in additional capital reserves they must maintain. Consequently, what's the rational course of action? Liquidate everything. Sell the gold, sell the silver, sell the bonds, and convert them into cash. Cash is the sole asset that reduces a bank's risk score. Therefore, the dramatic red candlesticks you observe on the charts are not a reflection of reduced demand from entities like Samsung, nor do they signify an end to supply constraints. Instead, they indicate that institutions such as JP Morgan and Citibank are obligated to demonstrate substantial cash reserves to the Federal Reserve this evening. They are offloading their holdings into an illiquid market to create a favorable appearance. This is purely a mechanical process, a regulatory cleansing. And because the market is thinly traded, especially during this holiday period, their selling activities have a disproportionately large impact. They might sell 1,000 contracts, causing the price to drop 50 cents. They sell 10,000 contracts and the price might fall $2. They are artificially driving down the price to generate liquidity. Once midnight passes, this particular regulatory obligation ceases to apply. The pressure abates and capital is free to flow back into the market. This explains the frequent occurrence of a V-shaped recovery observed in the initial week of January. Banks divest their holdings on December 31st and then repurchase them on January 2nd. You are currently witnessing the selling phase of this transaction. The buying phase is scheduled for Friday. Let us now turn our attention to the gold market. Gold is currently trading at $4,294, marking a decline of $76. This represents a substantial movement for gold. When gold experiences a significant downturn, silver tends to follow suit. Given that silver constitutes a smaller, more volatile market, it amplifies the price swings seen in gold. If gold has depreciated by nearly 2%, silver has fallen by 8%. This correlation serves as confirmation that we are dealing with a macroeconomic event, not solely an issue related to silver's supply. The focus here is on the US dollar. When financial institutions divest assets in exchange for cash, demand for the dollar experiences a significant surge. The dollar index is appreciating today, not due to robust economic health, but rather because of a scarcity of dollars within the banking system required to meet these year-end financial obligations. This dollar appreciation acts as a wrecking ball, decimating the value of all assets denominated in dollars. However, it's crucial to remember that a liquidity crisis is inherently transient. The Federal Reserve is aware of the dollar shortage and will likely inject liquidity into the market through repurchase agreements tonight to stabilize the banking sector. Once this injected liquidity enters the financial system, the dollar's value will recede and precious metals are poised to rebound sharply. We are currently in the eye of this liquidity-driven storm. Now let us address the technical damage that has occurred. A drop to $70.50 has indeed had a detrimental impact on the chart. It has disrupted the short-term upward trend and has resulted in a substantial, unattractive red candle on the daily chart. Technical traders, those who may not fully grasp the underlying fundamentals, will observe this and declare, "The trend is broken. Sell." This sentiment then triggers a cascade of further selling. Algorithmic trading systems detect the price decline and initiate further short positions, pushing the price towards the lower boundary of its trading range. We are currently testing the $70 support level. This represents a critical juncture. It is imperative that this level holds. If $70 remains a stable support, then this entire price collapse will be reclassified as a mere retest of the prior breakout level. A painful yet technically valid maneuver. Previous resistance often transforms into new support. Should we experience a rebound from this point, it will validate the existence of a substantial base of genuine buyers eager to capitalize on the discounted pricing. Observing the trading volume, we are witnessing absorption. Each time the price touches $70.50, buying volume experiences a spike, indicating that an entity is stepping in to absorb the selling pressure. Someone is declaring, "I will acquire your silver at $70. This entity is likely the astute investment capital positioning itself for 2026. Let us now address the sense of panic you may be experiencing. It is entirely natural. You observed the price at $75 yesterday, and today it stands at $70. You perceive a monetary loss, but it is essential to reframe your perspective. Did you sell yesterday? No. Are you selling today? No. Therefore, you have not incurred any actual loss. You still possess the physical ounces. The market functions as a mechanism for transferring wealth from the impatient to the patient. Today, the market is rigorously testing your patience. It is attempting to dislodge you from your positions before the anticipated January rally. It seeks to compel you to transfer your holdings to the financial institutions that are poised to repurchase them on Friday. Do not grant them that satisfaction. Contemplate the ultimate outcome. Does a decline to $70 alter the debt ceiling? Does it negate the fact that China is currently paying premiums for the metal? Does it change the reality that mine production is diminishing? Absolutely not. The fundamental underpinnings remain exceptionally robust. The price action is merely transient noise. It is loud, it is unsettling, but it is nonetheless noise. We will delve deeper into this analysis. We need to examine the divergence between the spot price and the physical market. Are dealers reducing their asking prices, or are they maintaining their prices at $80? We must assess the reaction of mining operations and formulate a strategy for the market opening on January 2nd. Because once the banks cease their selling activities, the resulting vacuum will reverse and the price could ascend as rapidly as it has fallen. We are currently witnessing the final spasms of volatility in 2025. The storm is indeed fierce, but our vessel is engineered to withstand such conditions. Maintain your composure. Let us now shift our focus to the reality of the physical market. If you observe the trading screen, silver is priced at $70.50. Logically, one would expect to acquire an American Silver Eagle coin for $74, correct? Incorrect. Proceed to the websites of reputable dealers immediately. I am currently reviewing them. The premiums have actually widened. Yesterday, the premium stood at $10. Today, it is between $12 and $15. The dealers are steadfastly refusing to lower their prices. The reason for this is simple. They recognize that this price decline is artificial, a paper-driven event. If a dealer were to sell you a coin today at $74 and the spot price were to rebound to $78 by Friday, they would incur a loss and they would be unable to replenish their inventory at that price. Consequently, they are maintaining elevated prices, reflecting the intrinsic value of the metal rather than its transient liquidity-driven valuation. This discrepancy is your definitive signal. When the spot price decreases, but the retail price remains elevated, it signifies a constricted physical supply and an absence of panic selling in the real world. No one is queuing at the coin shop to liquidate their holdings. The only individuals engaging in selling are leveraged traders operating on computer terminals. You must place your confidence in the physical market rather than the paper market. The physical market represents the truth. The paper market is subject to manipulation. Let us consider the industrial demand perspective. Envision yourself as a representative of Tesla or Samsung. You have allocated a budget for silver purchases in January. Yesterday, the price was $75. Today, it is $70.50. Are you dismayed? Not at all. You are delighted. You are initiating purchase orders as swiftly as possible, utilizing this dip to reduce your average acquisition cost for the year. This industrial buying activity establishes a firm price floor. The price can only decline so far before industrial consumers step in to acquire all available supply. We believe this floor exists precisely at $70. Below $70, the value proposition becomes overwhelmingly compelling. Manufacturing entities will deplete the available inventories. Therefore, while the banks are liquidating paper assets to rectify their accounting, industries are acquiring the physical metal. This exacerbates the supply shortage and facilitates the transfer of metal from less committed holders to more secure hands. Once the metal is incorporated into a manufacturing process, it is permanently removed from the market. We must also account for the potential for a short squeeze reload. Although the banks managed to cover some of their short positions earlier this week, in order to depress the price today, they likely had to re-establish short positions. They issued new sell orders to drive the price lower. This implies they have re-entered the trap. They extricated themselves on Tuesday, only to fall back into it on Wednesday. Come Friday, when new capital enters the market, they will be compelled to cover these newly established short positions. They are merely postponing the inevitable, and the challenge is intensifying. Eventually, this deferred problem will resurface and overwhelm them. The short interest is accumulating once again, thereby guaranteeing future upward price volatility. Every ounce they divest today is an ounce they will be forced to repurchase tomorrow at a higher valuation. Let us revisit the mechanism of the January effect. Why is January 2nd so pivotal? Because that is when new capital infusion occurs. Pension funds, endowments, 401k contributions, billions of dollars flow into the market on the first trading day of the year. Currently, the market is characterized by low liquidity. There are virtually no buyers. This is precisely why financial institutions can manipulate the price downwards with such ease. However, on Friday, buyers will re-enter the market and trading volume will rebound. When this influx of capital encounters the currently suppressed price level, we are likely to witness a dramatic reversal. It is conceivable that silver could surge from $70 back to $75 within a single trading session. This is the effect of a slingshot. By artificially pulling back the price today, they are accumulating the energy for a forceful launch on Friday. Do not capitulate and sell at the lowest point of this rebound mechanism. Now, I wish to address the bearish perspective. Could this represent a market peak? Is it possible for silver to recede to $50? Technically, anything is conceivable. However, from a fundamental standpoint, this is highly improbable given the persistent deficits, the geopolitical risks, and the escalating debt levels. A collapse to $50 would necessitate a severe deflationary depression characterized by widespread factory closures and societal hardship. In such a scenario, governments would resort to unprecedented levels of currency printing, which would inevitably propel silver's value to astronomical heights. Therefore, the bearish argument ultimately converges with a hyperinflationary outlook. There exists no plausible long-term scenario in which silver experiences a loss of real value. How, then, should you navigate the next 24 hours? Survival. Cease monitoring your account balance. Refrain from calculating your losses relative to the peak price. These are paper losses. not realized losses, unless you liquidate your positions. Focus on the quantity of your holdings. Maintain your long-term perspective. Utilize this period to prepare for the impending new year. Conduct an audit of your security measures. Review your asset allocations. If you have available capital, ready yourself for action. Should the price momentarily dip below $70, consider it the buying opportunity of the quarter. Be prepared to execute your trades. Embrace a strategy of being greedy when others are fearful, and at this precise moment, widespread fear prevails. In the subsequent segment, we will examine the critical technical levels to monitor. We will delineate the support zones at $68 and $70, project potential targets for a rebound, and discuss the impact of tax loss harvesting, which is contributing to the current downward pressure. The market's severe downturn is nearing its conclusion, and a recovery is imminent. Maintain your resolve. The year is concluding with a significant struggle, but we remain steadfast. We must closely scrutinize the technical repercussions. When a chart displays a substantial red candlestick, as we are witnessing today, it disrupts the short-term market structure. Momentum traders who typically buy during breakout phases have been eliminated from the market, having been stopped out of their positions. Trend followers, who rely on moving averages, are now liquidating their holdings. This creates a self-fulfilling prophecy of short-term weakness. We have breached the support level at $72 and are now precariously balanced at the $70 mark. Why is the $70 level so crucial? Because it previously served as a significant resistance level for several weeks, a ceiling that proved insurmountable. Now that we have surpassed it, it must function as a support floor. Should we close today's trading session below $70, it opens the door to a decline to $68, which represents the next significant structural support level. Would a drop to $68 prove fatal to the existing bull market? No. In the broader context, a correction from $83 to $68 constitutes a normal Fibonacci retracement, specifically a 38% retracement of the entire upward move from $50. While technically considered healthy, the emotional impact is profoundly distressing. It erases the gains accumulated over the past 2 weeks and can foster a sense of having made an erroneous investment decision. However, it is imperative to distinguish between price and intrinsic value. At $68, is silver inherently less valuable than it was at $83? Has its utility diminished? No. Has its scarcity changed? No. The sole factor that has shifted is the liquidity premium. The market is assigning a lower valuation because there is less available cash to deploy for bidding. This is a discount, not a fundamental devaluation. Let us delve deeper into the mechanism of tax loss harvesting. This is the unseen force driving the market downwards today. Today, December 31st, marks the Internal Revenue Service deadline for such activities. If a hedge fund acquired positions in silver mining companies at their peak in 2021 and continues to hold them at a loss, they will liquidate these holdings today. The motivation is to realize the capital loss, thereby reducing their tax liability on gains realized from investments such as Nvidia. Their decision is not driven by a disdain for mining companies, but rather by a strong aversion to taxes. This practice generates artificial selling pressure, selling that is dictated by the calendar rather than the underlying asset's fundamentals. And what occurs on January 2nd? The tax year concludes. The selling pressure dissipates almost instantaneously. The fund manager will then decide, okay, I have booked the loss. Now, I wish to reacquire the position. Consequently, they initiate buying activity. This is the essence of the wash sale dynamic, which artificially depresses prices in December and triggers a significant surge in January. We are currently experiencing the deflationary phase. The inflationary surge is less than 48 hours away. Now let us discuss the capitulation within the mining sector. If you examine the performance of exchange-traded funds such as the GDX or SLJ today, the charts resemble a scene of devastation, with declines of 10% and 12% respectively. Investors are abandoning their mining stock holdings, reasoning that if silver can plummet $8 in a single day, then mining equities represent an unacceptably high level of risk. This is the manifestation of fear. Consider the cash flow generated by these companies. Even at a silver price of $70, these entities are substantial cash flow generators. However, the market is not valuing them based on their cash flow today. It is valuing them based on liquidity. Mining stocks are considered high beta assets, meaning they are highly sensitive to broader market movements. When the overall market experiences significant volatility, the tail end of the dog, represented by mining stocks, experiences a violent snap. However, this severe price correction presents an unprecedented opportunity. We are witnessing high-quality producers trading at valuations that imply a silver price of $30. The market has become divorced from economic reality. If you possess available capital, this is where your attention should be directed. Invest in mining companies when there is widespread panic and despair in the market. And today, the market is awash in such sentiment. Let us now examine the broader macroeconomic context, specifically the bond market. The yield on the 10-year U.S. Treasury experienced a notable spike today. The reason for this is that financial institutions are liquidating bonds to generate cash, mirroring their actions in the silver market. When yields increase, it leads to tighter financial conditions, negatively impacting the stock market and fostering a risk-averse environment. However, there is a critical caveat. The U.S. government cannot sustain significantly higher borrowing costs. With a national debt of $36 trillion, every 1% increase in interest rates imposes hundreds of billions of dollars in additional interest payments on the government. Consequently, the higher interest rates climb today, the greater the likelihood that the Federal Reserve will intervene tomorrow. The sharp decline in the bond market effectively guarantees the next round of monetary expansion. The government will be compelled to print money to service its debt obligations. And when the government prints money, the value of precious metals tends to surge. Therefore, this downturn in the bond market serves as a precursor to the next upward movement in precious metals. It forces the Federal Reserve's hand. We are observing the system encountering critical stress points, enabling the Federal Reserve to implement inflationary measures as a solution. You possess an asset that serves as an inflation hedge. You are strategically positioned for the resolution, not the breakdown. Let us now focus on the market setup for January 2nd. The financial markets will be closed tomorrow in observance of New Year's Day. This provides a 24-hour period for reflection and calculation for all market participants. When trading resumes on Friday, participants will encounter silver priced at $70 and gold at approximately $4,300. Furthermore, they will confront a global landscape still grappling with resource scarcity. Bargain hunters will be poised at the market opening. Pension funds will be ready to deploy capital. Industrial hedges will be waiting. The selling pressure originating from the GSIB regulations and tax loss harvesting will have abated. This situation creates an upward vacuum. Just as we experienced an air pocket today during the price decline, we could experience a similar upward surge on Friday. Liquidity will be constrained, but the buying pressure will be robust and new. Therefore, do not be surprised if we witness a limit-up opening on Friday morning. The market has a propensity to inflict maximum discomfort on the greatest number of participants. It penalized the long positions today through its decline, and it will penalize the short positions on Friday through its ascent. This sharp reversal, or whipsaw, is designed to clear the trading board of positions. Now a brief discussion regarding physical delivery in January. The first notice day has already passed. Those who elected to take physical delivery are now awaiting their warrants. Given the precipitous price decline, one might assume they would withdraw from their commitments, but this is not the case. The open interest in the delivery month remains elevated. This indicates that buyers are committed to acquiring the physical metal. They are not deterred by the price drop. In fact, they are content to take delivery at $70 rather than $79. This reinforces the reality of a physical shortage. If these buyers were purely speculative traders, they would have exited their positions. The fact that they are maintaining their commitments validates their status as industrial consumers who require the actual atoms of the metal. The depletion of physical inventories continues. Today's price action represents a tempest in the paper market, while the physical foundation remains unyielding. Let us address the concept of emotional capital. You possess both financial capital and emotional capital. Today, you have expensed a considerable amount of your emotional capital. It is undeniably taxing to witness your net worth diminish. However, you must prioritize recharging. Disengage from your screen. Cease observing the red candlesticks. Instead, focus on celebrating the new year. You cannot influence the price by fixating on it. You must have unwavering faith in your investment thesis. What was your rationale for acquiring silver in the first place? Was it for a quick profit, or was it because the fiat currency system is mathematically destined for collapse? If the fiat system's demise remains a certainty, then your investment thesis is still valid. The timeline may have experienced adjustments and the path may be more arduous, but the ultimate destination remains unchanged. Do not permit a singular day of liquidity-driven volatility to derail a generational investment opportunity. We will conclude this section by examining the global perspective. While New York is engaged in selling activities, what is occurring in Shanghai? We do not yet have real-time data, but historically, China tends to capitalize on price dips. When Western markets divest gold and silver, the East typically acquires them. It is highly probable that a substantial transfer of physical metal from Western depositories to Eastern ones is currently underway. The price decline facilitates this transfer, making it more economically advantageous for China to deplete global stockpiles. We are, in essence, subsidizing our own long-term disadvantage. History will likely characterize this day as the moment when the West relinquished its strategic reserves for a pittance. In the subsequent section, we will outline the roadmap for recovery. What will the chart trajectory look like from this point forward? How long will it take to reclaim the $75 level? We will analyze the probability of a V-shaped recovery and provide you with a definitive checklist for the new year. The market's severe downturn is painful, but its conclusion is at hand. A recovery is set to commence in approximately 48 hours. Remain vigilant. We are discovering the path towards light. We must now chart the course for the market's recovery. The market has endured a significant blow, much like a boxer absorbing a heavy punch, temporarily knocking the wind out of it. However, markets, much like resilient fighters, possess an inherent capacity for recovery. So, what form will this recovery take? Will it be a gradual, protracted grind higher, or will it be a rapid, forceful rebound? Based on the underlying mechanics driving this downturn, the GSIB regulations, the tax loss selling, and the constrained liquidity, a V-shaped recovery is the most probable outcome. The reason for this is that the selling pressure was driven by external events rather than a fundamental decline in value. The sellers did not divest their holdings because silver has lost its intrinsic worth. They sold because the calendar date dictated it was December 31st. Once the calendar advances to January 2nd, the impetus for selling will evaporate. This will create a significant void in the market. Sellers will exit, buyers will re-enter, and the price will be compelled to rise to meet the available demand. It is conceivable that silver could reach $73 by the close of trading on Friday. We might even see a return to $75 by the following Monday. The speed of the recovery will likely mirror the speed of the price decline. Let us revisit the targets for the January effect. With the price now recalibrated to $70, the upside potential for January has been significantly amplified. If pension funds enter the market at this $70 level, they could potentially drive the price to $85 without it appearing to be an overheated bubble. This price reset effectively extends the runway for the current bull market, providing additional room for growth before reaching a state of euphoria. Therefore, in a peculiar manner, this sharp decline has actually bolstered the prospects for a sustained rally. This downturn averted a precipitous decline that could have prematurely concluded the present cycle. Now let's examine the short sellers who profited today. They are currently holding gains, but they understand the dynamics of this market. They are aware of the January phenomenon, and they recognize that maintaining short positions into the new year is akin to professional suicide. Consequently, they will likely transition to buying on Friday. They will cover their positions amidst any weakness, repurchasing their sold assets to secure their profits. This action injects additional buying impetus into the market. The process of short covering represents the most dependable source of demand following a significant price drop, establishing a floor under the asset's value as short sellers are compelled to buy back their positions to exit. Turning our attention to the macroeconomic data scheduled for release next week, the first week of the month typically brings the Manufacturing Purchasing Managers Index and crucial employment figures. Should this data prove disappointing, the market will likely interpret it as a precursor to a recession. A recession, in turn, signals a potential shift in monetary policy by the Federal Reserve, which would translate to lower interest rates. Lower interest rates are historically beneficial for silver prices. Conversely, if the economic data is robust, the market will likely anticipate a surge in inflation. Inflationary environments tend to favor commodities, and thus higher commodity prices would benefit silver. This creates a win-win scenario, irrespective of whether the economy experiences a boom or a contraction. Silver stands to gain. The only environment detrimental to silver's price appreciation is one of sustained stability. Considering the current global landscape, does it appear stable to you? Unlikely. We should re-emphasize the situation with physical silver dealers. If you are contemplating acquiring physical silver, this price dip presents a fleeting opportunity. However, swift action is paramount. The dealers are observing the same market charts. If they perceive a price rebound on Friday, they will undoubtedly increase their premiums once more. This favorable buying window might only remain open for approximately 24 hours. If you have readily available capital, now is the opportune moment to deploy it. Contact your dealer, ascertain their inventory levels. Even if the premium is elevated, acquiring silver at $70 per ounce is financially advantageous compared to its potential future price of $80. You are effectively purchasing at a discount on the underlying asset's base price. Let's analyze the gold to silver ratio. With silver experiencing an 8% decline and gold down 3%, the ratio has widened, increasing from below 60 to over 62. This development renders silver comparatively less expensive relative to gold than it was yesterday, attracting traders who focus on ratio arbitrage. These traders will likely divest their gold holdings to purchase silver, anticipating a contraction of the widened ratio. This arbitrage opportunity provides a supportive underpinning for silver, preventing a free fall in its price. The gold market effectively acts as a stabilizing mechanism. Now let's address market sentiment. I've reviewed the commentary and observed the prevalent apprehension with sentiments like, "It's rigged and they'll never let it go up." This palpable frustration serves as a significant indicator, signaling a potential capitulation phase. When the average investor abandons their positions, expressing despair over a perceived rigged system, it often marks a market bottom. The market has successfully purged excessive optimism, clearing the path for a subsequent ascent up the wall of worry. Bull markets typically originate from pessimism, mature through skepticism, transition to optimism, and ultimately collapse under euphoria. Today's price action has returned us to a state of pessimism, suggesting a rebirth of the bull market. Examining the commitment of traders report, next week's data is expected to reveal a substantial reduction in the commercial short position. Major financial institutions have utilized this price correction to reduce their exposure. This implies a diminished incentive for them to aggressively suppress prices in the coming week, having effectively de-risked their portfolios. With the larger players holding fewer short positions, the path of least resistance for the asset's price is upward. The downward pressure has been effectively discharged. Furthermore, we must consider the necessary repair of technical damage. The duration required to rectify a compromised chart pattern typically involves a few days of consolidation characterized by sideways trading. It is reasonable to anticipate silver fluctuating between $70 and $72 for several days. This period of base building allows moving averages to realign and traders to regain composure. It is essential not to become discouraged by this sideways movement. It serves as a vital bridge between a downward trend and an upward trajectory. Shifting our focus to the global liquidity cycle, central banks worldwide are implementing easing measures. China has reduced interest rates, and Europe is following suit, leading to an expansion of the global money supply. This increased liquidity naturally flows into various asset classes, seeking opportunities like water filling every available space. Currently, liquidity has been drawn away from silver due to year-end market adjustments. However, in January, this trend is expected to reverse, with liquidity flowing back into the precious metal. The global M2 money supply chart represents the most critical long-term indicator, and it consistently trends upward. Silver is intrinsically linked to this trend and has little choice but to follow. As we approach the year's conclusion, it is crucial to maintain perspective. You are holding a strategic asset in an era of diminishing resources. You possess real money amidst a landscape of increasingly devalued fiat currencies. While the price may have declined today, the inherent value of silver remains unchanged. It is intrinsic, chemical, and historical. $70 is merely a digital representation, whereas the physical ounce in your possession is the tangible reality. In the concluding segment of this discussion, we will outline the definitive strategy. I will provide specific price levels to monitor on Friday morning and advise on how to position your portfolio for the market opening in January. Finally, I will offer my definitive assessment on why this price correction represents the most beneficial development of the year, providing a reset, a discount, and a launch pad for future gains. The market carnage has concluded. The recovery is now initiating. We have reached the final phase of this market update. We have meticulously analyzed the regulatory adjustments that precipitated silver's decline to $70.50, examined the contagion effects from the bond market and the panic selling executed by hedge funds. We have also observed the physical dealers maintaining their premium structures. Your portfolio, though tested, remains resilient. You stand at the precipice of 2025, a year marked by significant breakthroughs and a heightened awareness of fundamental shifts, concluding with a test of your resolve. In this final breakdown, Part 4, I will present the strategic plan for January 2nd. I will detail precisely what to anticipate when the markets reopen on Friday morning, provide the physical buying signal, the specific price and premium combination that signifies it is time to acquire significant quantities, and deliver my final verdict on why this price correction is the essential fuel for the rocket poised for launch in 2026. The major financial institutions have expended their final ammunition for the year, narrowly missing their intended target, and now the bullish momentum is reasserting itself. Let us conclude this chapter. Tomorrow is New Year's Day. The financial markets will be closed, electronic trading systems will be inactive, and the bankers will likely be recuperating. It is a period of quietude. Utilize this interlude to prepare for on Friday morning, January 2nd at 8 o'clock Eastern Time, the opening bell will signify the commencement of the January effect. What can we expect at the market open? Given the severity of today's sell-off, the market is demonstrably oversold. The speculative pressure has been excessively extended to the downside. When the new capital influx from pension funds enters the market on Friday morning, it will encounter an unburdened order book. The sellers have already exited their positions, having done so today. Consequently, buyers will be compelled to drive prices upward. I anticipate a significant gap up on Friday morning, with the potential to open at $71 or $72, potentially recovering half of today's losses within the first hour of trading. This phenomenon is often referred to as the slingshot effect. The GSIB regulations, which mandated a reduction in certain positions, have expired, allowing for a strong rebound. For traders, this presents a prime opportunity. For investors, it serves as a confirmation of underlying strength. Monitor the opening. A gap up accompanied by substantial trading volume will officially signal the end of the price correction and confirm that the market's low has been established. Now let us revisit the physical metal market one last time. Today, silver is available at a reduced price, with the spot price down 8%, but premiums remain elevated. So when is the optimal time to purchase? The ideal moment is after the initial panic subsides, but before the price fully reflects this stabilization. This often occurs approximately 24 hours post-correction. Dealers are currently in a state of flux. They increase premiums due to apprehension. By Friday, they are likely to become more composed and may slightly lower premiums to stimulate activity. If you can acquire silver at an all-in price of $75 while the spot price is actively recovering, it represents an exceptional value. You are purchasing an asset that was valued at $83 just yesterday. effectively securing a 10% discount on its future potential. Avoid attempting to pinpoint the absolute lowest price. You risk missing the opportunity altogether. If you observe physical metal available at a price lower than it was on Monday, seize the opportunity. This window of favorable pricing will likely close once institutional buying commences next week. As major funds begin their acquisitions, physical inventory will rapidly deplete and premiums will surge once more. Let us shift our gaze towards the horizon, specifically to 2026. This is the year when the fundamental drivers will truly manifest. The deficits have been cumulative, with vaults depleted for 5 consecutive years. We are entering the 6th year of deficit, and mathematically, this is the year when warehouse reserves are projected to reach zero. At that juncture, the price determination mechanism will fundamentally change, transitioning from speculation-driven to scarcity-driven. Scarcity pricing exhibits exponential growth. It doesn't increase by 10%, but rather by 100%, continuing until demand is significantly curtailed. We are looking at a year where silver could potentially reach $150. This may sound improbable given today's declining chart, but recall that oil prices surged from $40 to $120 within a 2-year span. Commodity prices can escalate rapidly when shortages emerge. Therefore, do not allow today's price action to obscure the reality of next year's potential. The underlying debt issues persist, solar panel production continues to expand, and geopolitical tensions remain elevated. The fundamental catalysts supporting the bull market are even stronger today than they were yesterday. This is because the current price offers a more attractive entry point. A lower price, coupled with unchanged fundamentals, translates into a superior investment opportunity. Here, then, is the definitive analysis of the year-end price correction. It was a manipulated event, a regulatory maneuver designed to shield banks from capital requirements with no bearing on the intrinsic value of silver. It was driven entirely by the operational mechanics of the banking system. You have navigated this challenge successfully, maintained your positions, and resisted the urge to panic sell, proving yourself to be a strong holder. Now embrace the new year and celebrate the distinction of owning an asset that exists outside the conventional financial system. You possess the money of the people and the energy of the future. As the sun rises on 2026, the market dynamics will reset, the playing field will be leveled, and the silver market will be poised for significant upward movement. You were early, you were correct, and you are prepared. Welcome to the year of the substantial price appreciation.